It doesn't start with a missile, it starts with a delay notice. A container ship slows down. An insurance premium quietly doubles. An oil tanker changes course. And somewhere thousands of miles away, a factory manager stares at a spreadsheet that suddenly doesn't make sense. This month, the Middle East isn't just a geopolitical headline. It's a shipping story, an oil story, a trade story. And if you look closely enough, it's a story about the invisible plumbing of the global economy. Plumbing most of us never think about until it leaks. Because when conflict flares in the Middle East, the shock doesn't stay there. It moves. Through shipping lanes, through fuel prices, through insurance markets, through supermarket shelves. And right now, those shockwaves are building again. Let's start with geography. If you draw a thin line on the map between the Persian Gulf and the Arabian Sea, you'll find the Strait of Hormuz. It's narrow, tight, almost unimpressive at first glance. But roughly 1/5 of the world's oil consumption passes through that sliver of water every single day. Now move slightly west and you hit the el-Mandeb, connecting the Red Sea to the Gulf of Aden. This is the gateway to the Suez Canal, the shortcut between Asia and Europe. These are not just lines on a map, they're pressure points. When conflict intensifies in the region, whether it's between Israel and Iran, militia groups targeting commercial vessels, or retaliatory strikes that raise fears of escalation, shipping companies don't wait for certainty. They respond to risk. And risk has a price. Over the past year, we've watched insurance premiums for vessels transiting the Red Sea spike dramatically. In some cases, war risk premiums jumped from a few $1,000s per voyage to hundreds of thousands. For large oil tankers or container ships, that cost gets passed along. Always. If the risk climbs further, ships reroute. Instead of passing through the Suez Canal, many vessels have begun sailing around the southern tip of Africa, around the Cape of Good Hope. It adds roughly 10 to 14 days to a journey between Asia and Europe. That's fuel, that's crew time, that's fewer trips per year. Shipping is built on precision, on schedules measured in hours. When that rhythm breaks, costs compound. Now, layer oil on top of that. Oil markets are forward-looking. They trade on fear before reality. If traders believe that supply through the Strait of Hormuz could be disrupted, even temporarily, they bid prices higher. The world consumes roughly 100 million barrels of oil per day. Around 20 million of those move through Hormuz. If even a fraction of that flow is threatened, futures markets react immediately. It doesn't require an actual blockade, just the credible risk of one. This is the uncomfortable math of geopolitics. Uncertainty alone can move billions of dollars. We've already seen oil prices swing sharply on news of airstrikes, drone attacks on tankers, and political threats. A few dollars per barrel might not sound dramatic, but multiply that by 100 million barrels per day. That's hundreds of millions of dollars in daily global energy cost shifts. And oil doesn't just power cars, it powers shipping, aviation, plastics, fertilizers, packaging, manufacturing. When oil moves, everything moves. But here's where it gets more interesting. The popular narrative says conflict equals oil spike equals inflation. Clean, simple, predictable. Reality is messier. The United States, thanks to shale production, is now one of the world's largest oil producers. Countries have strategic petroleum reserves. OPEC calibrates output. Demand growth isn't what it was a decade ago. Markets know this. So when oil jumps on geopolitical headlines, traders immediately ask a second question. Is this fear? Or is this structural? Is supply actually being removed from the market? Or is it just at risk? If tankers are still flowing through Hormuz, if Saudi production remains stable, if Iran's exports continue quietly via intermediaries, then price spikes can fade as quickly as they appear. That push and pull between fear and fundamentals is defining this month's trade story. Now let's zoom out beyond oil. Container shipping is the bloodstream of global trade. Roughly 80 to 90% of world merchandise trade by volume moves by sea. Clothes, electronics, machinery, food. When ships reroute around Africa instead of passing through Suez, capacity effectively shrinks. Fewer ships complete fewer round trips each year. It's a subtle squeeze. But in a system already tight from pandemic aftershocks and shifting trade alliances, subtle squeezes matter. Freight rates on key Asia-Europe routes have surged again, Not pandemic-level surges, but enough to remind businesses how fragile logistics can be. And here's the irony. For the past 2 years, central banks have been fighting inflation by raising interest rates. Demand has cooled, goods inflation has eased, shipping costs had normalized dramatically from their 2021 peak. Just as that relief began to feel durable, geopolitics re-entered the chat. If freight costs climb again and oil sustains higher levels, companies face a familiar dilemma: absorb the cost or pass it on. Absorbing it means thinner margins. Passing it on means higher prices. Neither option is particularly comforting. Now let's talk insurance, because this is where the story gets quietly fascinating. Shipping companies don't just worry about missiles hitting vessels. They worry about probabilities, about actuarial tables, about risk models recalibrating in real time. When insurers classify an area as high risk, premiums can increase tenfold overnight. Some insurers even require ships to provide additional security measures or accept special clauses. Insurance isn't just a side cost. It can determine whether a route remains commercially viable. If premiums get too high, rerouting becomes cheaper than sailing through danger. This is how conflict in one region can redraw global trade maps without a single port officially closing. And the ripple effects don't stop at oil and containers. Liquefied natural gas shipments often transit through the same choke points. Europe, still recalibrating after losing large volumes of Russian pipeline gas, relies heavily on LNG imports. Any perceived disruption in shipping lanes can influence European energy prices almost immediately. Energy markets are tightly interwoven. Meanwhile, emerging markets feel the pressure first. Countries that import most of their fuel, think parts of South Asia, Africa, and Southeast Asia, are especially sensitive to oil price swings. A $10 increase in crude can widen trade deficits, weaken currencies, and strain government budgets. It's not just a number on a commodities chart, it's fiscal stress. And that's before we even touch food. Oil affects fertilizer production. Shipping costs affect grain transport. If routes through the Red Sea remain unstable, grain shipments from the Black Sea and beyond face higher costs and potential delays. The chain reaction is subtle but real. Higher transport costs, higher input costs, higher consumer prices. Now here's the twist. Financial markets for now seem relatively calm. Equity indexes wobble on headline days but recover quickly. Bond yields move more on central bank comments than on Middle East developments. Volatility spikes briefly, then retreats. Why? Because investors have become conditioned to regional flare-ups that don't spiral into global war. There's a kind of fatigue, a learned skepticism. Markets are essentially saying, show me the actual supply disruption, until tankers stop moving in large numbers, until production facilities are damaged, until governments impose formal blockades. This remains a risk premium, not a structural shock. But that calm carries its own risk. Complacency can evaporate quickly. Remember 2019 when attacks on Saudi oil facilities temporarily knocked out a significant share of production? Oil spiked sharply in a single day. Production was restored faster than many feared, but the shock was real. Or think back to the Suez Canal blockage in 2021, when a single container ship wedged sideways halted traffic for nearly a week. Global trade paused because one vessel miscalculated a turn. One ship. The global economy is vast, but it has narrow bottlenecks, and the Middle East sits on several of them. Let's walk through the uncomfortable scenario. If hostilities escalate and a major power directly intervenes, if the Strait of Hormuz is partially closed, even briefly, if tankers are physically prevented from transiting, oil could spike dramatically, well beyond incremental moves. Strategic reserves might cushion the blow, but markets would react first, stabilize later. Shipping rates would surge, insurance would explode. Governments might impose emergency measures. Central banks would face an ugly trade-off. Inflation up again, growth slowing again. It would feel uncomfortably like 2022. Now contrast that with the more likely scenario. Continued tension, sporadic attacks, elevated premiums, but no full closure. In that world, oil fluctuates in a wide range. Shipping reroutes become semi-permanent. Companies adjust. Inflation ticks up slightly but doesn't spiral. The global economy absorbs the shock. That's the difference between drama and structural change. Right now, we're somewhere in between. The system is absorbing higher costs, but it's doing so with less slack than before. Growth in Europe is fragile. China's recovery is uneven. The US is balancing strong labor markets with persistent inflation concerns. In other words, this isn't 2010. There's less cushion. And then there's politics. Energy prices are politically toxic. Fuel at the pump is one of the most visible economic signals voters see. Governments watch oil markets carefully, not just for macroeconomic reasons, but for electoral ones. That means diplomatic efforts to prevent escalation aren't purely altruistic. They're economically motivated. Stability in shipping lanes is a global public good, and public goods are most appreciated when they are threatened. So, what should we actually watch this month? First, tanker traffic data through the Strait of Hormuz and Bab el-Mandeb. Are volumes declining materially or merely fluctuating? Second, war risk insurance premiums. If they continue climbing, that signals sustained fear, not just temporary headlines. Third, freight rates on Asia-Europe routes. A sustained spike tells you rerouting is biting harder. Fourth, OPEC production signals. If major producers increase output to calm markets, that's a stabilizing force. If they hold back, volatility stays. And finally, central bank commentary. If policymakers begin explicitly referencing geopolitical energy risks again, you know it's feeding into inflation expectations, because expectations matter almost as much as actual supply. Here's the quiet truth beneath all of this. Globalization never disappeared. It just got more expensive. The pandemic exposed how fragile supply chains could be. Companies responded by diversifying suppliers, nearshoring some production, holding slightly higher inventories. But the physical reality remains. Energy and goods still travel through narrow passages controlled by geopolitics. You can diversify factories, you can't diversify the Strait of Hormuz. And that's why this month's conflict matters beyond headlines. It's not just about who fired what. It's about how the world's most important trade arteries respond under stress. For now, oil hasn't exploded. Supermarket shelves aren't empty. Container ports are still operating. But the risk premium is back, and risk premiums are like pressure in a pipe. You don't always see them. You just feel the tension building. The global economy today is walking a narrow line between resilience and overconfidence, between temporary disruption and structural fracture. If the shipping lanes remain open, this will fade into another episode of contained instability. If they don't, the math changes fast. So the question isn't whether conflict in the Middle East matters. It always does. The question is how much slack the global system has left. Because in a world that runs on just-in-time logistics and thin profit margins, it doesn't take a missile to disrupt trade. Sometimes it just takes a narrow strait. And a little bit of fear.